Welcome back to your Mortgage Insider Update for this week. It is May the 10th. CPI came out today for the month of April. It was a little bit less than expectation, but a lot higher than we had hoped for. We're going to dive into a little bit of the charts and kind of what's going on with the Consumer Price Index, but it does appear that inflation is a little stickier than we had hoped. We finally got to a point, though, where the federal funds rate is now sitting at 5%, between 5 to 5.25%. That's the federal funds rate after last week's rate increase. CPI came out at 4.9%. So we're just now inverted where the federal funds rate is greater than the consumer price index headline number. Now the core inflation, and this is really the problem, is that's the sticky part. That's coming in about 5.4%. So a little bit less than prior month, a little bit less than last year, but not falling off a cliff, which is what we would hope for. We are expecting as the summer goes on, we will continue to arrive at a lower and lower rate of inflation through the month of June, which we won't see those numbers until early July. So more of the same. Let's check out the charts. Mortgage markets are improving today. This is after a week of unimprovements. So let's take a look first at the 10-year, down 7 basis points today at 3.456%. Now that's a far cry better. Now I have a 6-month chart here for a little bit of longer term effect. So we're getting into we're in May. So through December of last year, we can see into December where we saw low points that were lower than we are right now, but we're getting pretty close to those points where rates actually bottomed, and that has been the bottom. As we look, it's gone up. We've definitely had, times at the end of December, and then in mid-January, we came back down to the same level we're right around currently, and then this huge run-up that happened until March when the SVP Bank burst and the rates fell, but they fell right back to the same level. So this week we actually saw rates back on May 3rd, just prior to the Fed meeting, improving even more. The Fed chairman spooked the market a little bit. Rates have moved back up. That's through the beginning part of this week. And then today, the CPI report, we are seeing a lowering on interest rates on the 10-year. So if we just look at the range here, we are at the low end of the range, but we're still in the 6.5% rate on the mortgage side. So as we look at the mortgage-backed security, we see green is good on this chart, 23 basis point improvement in the mortgage-backed security pricing. This works the reverse to the interest rates. This is the investor's price that they're paying for the investments in a 5.5% mortgage coupon. So the consumer doesn't get 5.5% because the margin goes above the note rate. As the traders are trading this, they're getting 5.5% return in the long run, whereas the mortgage company is collecting for fees for the mortgage originator and the processing and the operations of the entire mortgage secondary market. All that is built on top of that mortgage-backed security. So we can see mortgage-backed security prices have increased. So knowing that this works in reverse, positive here, this has gone up. We are right at the 100-day, the 25-day, and the 200-day averages. Yesterday we hit the 50-day moving average and actually have now bounced back above that. That's a positive sign, but not a convincing sign that mortgage-backed security prices, meaning the interest rates would fall as this continues to climb. We actually got there last week. Right before the Fed spoke, we were improving and mortgage-backed securities and had a pretty big day, but ended the day kind of flat. And then now we've got the couple days of deterioration overall. Lower prices meant higher interest rates. And if we wanted to look at the same 6-month time period like we did on the 10-year, you can see that same range. So we're not at the best or the worst of the last 6 months. We're treading water. So that's about the most we can hope for right now, treading water. So interest rates are not getting any worse. Let's sell the rates and the home prices as they stand right now, and then hope for summer to continue to improve those inflation numbers. We will get producer price index this week. The next Fed meeting will not be until June, and we're expecting to have a lot more data, including the inflation data for May, which we won't get till early June by the time of their next meeting. Later this month, we'll also see the personal consumption expenditure, and that'll again be before the next Fed meeting, which is one of their favorite measures of inflation. Have a great one.